Newcomer to Canada or have lived here all your life. Doesn't matter. If you're just starting out on your investment journey, then this video is for you. Now in Canada, there are several types of investment accounts that investors can open. Now each of these accounts have their own characteristics and features. Broadly, we can categorize these as registered accounts and non-registered accounts. I'll just talk a little bit about registered accounts before going to non-registered accounts. Now, as a Canadian, you have access to accounts registered with the CRA, which is the Canadian Revenue Agency, and each of these accounts have their own features, and they're different from one another, and they help you to save or invest towards your financial goals. The most common registered investment accounts are the ones that you see here, which is the TFSA, tax-free savings account, RRSP, registered retirement savings plan, RESP, registered education savings plan. Now, before we talk about each of these, keep in mind that once you're eligible, you do have the option of opening a self-directed account or a managed account. Now, the decision to open one versus the other is based entirely on your comfort with investing. I personally think that everyone must learn to do this yourself because whoever you bank with, no matter which bank you work with, they will try to and push their own mutual funds. They will definitely sell you their products. So at least some of these accounts, try to open a self-directed account and manage your own investments. But again, learn how everything works before you jump in and manage your own investments. So that is something very, very important. So let's get into each of these three registered investment accounts. So the TFSA, as the name implies, it's tax-free savings. So this was launched in 2009, and you can you can invest a defined amount tax-free each year throughout your life. Now all the investment gains made within this account are tax-free, even when you withdraw any of those dollar that you gain from the investments from the account. Now to open a TFSA, you need to be at least 18 years of age and have a valid Canadian social insurance number. Now at any time, if you want to check the contribution amounts for any specific registered account, you can always go to the Government of Canada website and find out what the limits are. Now keep in mind, with the TFSA, you cannot over-contribute, and there are penalties for doing so. Now every year, I think you can contribute about $6,000 towards your TFSA, and this contribution amount limit, again, like I said, can be checked on the Government of Canada website. Now RRSP is an account that's designed to reduce the income tax on the money you contribute towards your retirement. Now this just offers tax benefits. Now the requirements to open this are very simple. You just need to be under 69 years of age, have available contribution room, and also file income taxes with the Canadian government. Now a specific contribution limit is set each year, and this can accumulate. Now the contributions to this RRSP account for the current tax year can be made until March 1st of the following year. So we are right now working for the 2021 tax year. So I have time until March 1 of 2022 to contribute to this year's RRSP. Now I can contribute up to 18% of my previous year's income up to a maximum limit. Now the contributions to this RRSP account are tax deductible. So this will result in lower taxes each year that I make a contribution. So for example, if my marginal tax rate is 30%, and if I'm contributing $10,000 towards my RRSP, then I can claim a tax deduction come tax time and save about $3,000 in taxes. So that is 30% of that 10,000, which is 3,000. Now the earnings on the RRSP account, all the capital gains, the interest income, and the dividends, they all continue to grow tax-free until you actually start making the withdrawals. Now that's where the RRSP falls short of the TFSA, because when it comes to withdrawals from the account, there is generally a withholding tax that is applicable when taking money out of the account for any reason. Now the only exceptions here would be if you were to pay for post-secondary expenses, or if you're buying a new home, then you can take money from your RRSP account without paying any of the taxes. But again, keep in mind you'll have to recontribute whatever you're taking. So that is important. Now, once you're ready to retire, this RRSP account will automatically be turned into an RRIF account. So that is nothing but the Registered Retirement Income Fund. So essentially, at 71 years of age, this RRSP account automatically gets converted to RRIF. Now, withdrawals will only begin at the latest as of age 72. Now, the other type of account is the RESP account. Now, parents can use this RESP account to save for their child's post-secondary education. Now, we can contribute up to $50,000 to the account per child and use either an individual account or a family RESP account based on the number of children you have within your family. Now, the benefits of the RESP is that it includes tax-free growth and later taxation at either 0% or a very low tax rate in the hands of your child when they withdraw funds to pay for their school. Now, what's interesting here is the government matches your RESP contributions at a rate of 20 cents for every $1 you contribute. That's about 20%, up to $500 maximum per year through the Canada Education Savings Grant. Now, low to moderate income families may also be eligible for extra government grants through the additional CESG and Canada Learning Bond, which is the CLB. Now, grant money is available until your child turns 18, and a child can get up to $7,200 in maximum CESG benefits and up to $2,000 in CLB benefits. This explains the three main types of registered investment accounts. Talking about the non-registered investment accounts. Now, if you've maxed out all your registered accounts and if you have additional funds to invest in, then a non-registered investment account is definitely worth taking a look, because this is the most flexible of all the accounts, because there is no age or there is no contribution limits for these accounts, and you can add or withdraw as you please. The interest income in a non-registered account is taxed at your marginal tax rate, but it includes special considerations for dividends and capital gains. So the dividends from your investments are taxed on a gross amount, but you also receive a dividend tax credit based on the province you live in. So it makes sense to invest in dividend-paying stocks if you do have a non-registered investment account. Now, the capital gains within the non-registered investment account are also taxed on a net basis with your marginal rate paid on 50% of the value. So any gains you make, 50% of the gains will be taxed at that marginal tax rate. Now, any interest income generated within this is also fully taxable at your marginal tax rate. Now, there are only two types of non-registered investment accounts that are available. One is either a cash account or a margin. The other is a margin account. Cash account is nothing but you use this basic account to purchase investments using whatever cash that is available in your account at the time of the transaction. Now, margin accounts would be ones where you're essentially borrowing funds from your broker, and you're essentially borrowing funds. So you're essentially using leverage to possibly amplify your gains by borrowing funds against the value of your existing investments. But I'll talk a little bit about how you can use these different types of account and what investment vehicles you can essentially get into.